Well, the Bitcoin price has been rallying. That's come as welcome relief to Bitcoin miners. There's a lot of things going on the regulatory front. Let's bring in Fred Thiel, CEO of Marathon Digital Holdings. Over the past year, your stock has recovered pretty significantly, though well off of its peak, and outperformed the moves that we've seen in the price of Bitcoin. Fred, remind us about kind of the economics of being a miner. There's the energy inputs, there's the price, obviously, and where things stand right now.
So there are a couple of levers that impact profitability. One is obviously the price of Bitcoin, energy cost is the other, and the global hash rate, which is the total amount of compute power that our industry applies to solving this equation, because the rewards or the subsidy that we're paid for winning blocks is a finite amount per day. There are a finite amount of blocks, so it's kind of a zero-sum game. And the more compute power there is, the more difficult it gets for us. And the global hash rate has grown by well over 100% in the last 12 months. So it's become twice as difficult for us to do what we do. But we're very fortunate. We have one of the most energy efficient fleets in the industry today. And we have been able to position ourselves well with our energy providers and our hosting contracts. And we continue to expand with renewable energy on the international and domestic basis, working very focused on optimizing our cost even lower.
So it's interesting on that energy part, because analysts have described your approach as asset-light hosting strategy. What does that mean?
So in the boom time in our market, the fastest way to expand was to partner with third parties who would invest in the infrastructure. And then as a miner, we would bring the mining hardware, if you would, the mining rigs, which is about 70% of the total CapEx spend of a project historically. And so to grow faster, we relied on third parties who would build infrastructure, and then we would essentially pay them to operate the sites for us, and part of the profit they would generate would go to pay back the infrastructure costs the investment they had made. We have since shifted our model much more towards a build and own model. The site that we developed in Abu Dhabi, which is started going live in July and will be completed by the end of this year, is fully designed and built by us. It's owned as a joint venture together with the Sovereign Wealth Fund of Abu Dhabi. And we continue to develop and build new sites, both domestically and internationally, using that model where we own and operate the site, because we've now developed a technology stack that allows us to do this much more efficiently than other miners. For example, our site in Abu Dhabi, the pilot site, ran for over 100 days before an engineer had even go on site and touch any of the equipment. That dramatically lowers your operating overhead for these sites. So we believe as an operator, we can be much more efficient than even the top operators in the industry.
And how does that position you for this thing that happens in Bitcoin for mining rewards, in which those rewards are cut in half every 4 years? That's coming up next year?
Correct. Yes, the halving, as it's called, or some people call it the halvening. Yeah. Every 4 years, the way the Bitcoin network was originally designed by its founders was that the block subsidy that we receive it drops in half. The theory being that you have a supply shock in the market, it drives the price of Bitcoin up, and as adoption grows, transaction fees, which are added on top of that subsidy, would make up the difference. So every 4 years, we have an incentive to get very, very, very efficient as an industry. And typically every 4 years, there's a cleansing, if you would, of the least efficient operators. So we believe that if the price of Bitcoin stays in the range-bound area where it is today, somewhere between 25 or 22 and 30,000. The cost to mine a Bitcoin will double in end of April of next year. So if the average industry cost today is somewhere around $16,000, $17,000 per Bitcoin to mine a Bitcoin, well, that goes to 32,000 in May. And if the price of Bitcoin isn't somewhere near 40,000, then the least cost efficient and producers will be negatively impacted. So we believe this will be a great market for consolidation. We've spent the past year cleaning up and tidying up our balance sheet. We paid down 52% of our outstanding debt at a 22% discount, convertible bond that we bought back recently. That was generated $100 million savings to our shareholders. We have over $400 million of cash and Bitcoin freely tradable on our balance sheet. So we believe we're in a position to consolidate and really acquire the most attractive power contracts that are out there. We're also very focused in optimizing our business towards what we have as a goal called zero cost energy, doing things in the renewable sector where we can benefit from all the incentives of things like methane gas capture, IRA programs, et cetera.
I mentioned there's a lot going on. There's, this application for spot Bitcoin ETFs. There is, of course, at the backdrop, the FTX trials that are going on, which will, I guess, serve as a reminder of, things can implode quite spectacularly in cryptocurrencies. How would you characterize institutional support and the conversations that you've been having since that time?
Yeah, it's a great question. I spent a lot of time in Washington, D.C. and New York talking to both the investment community and the regulators and the legislators. Bitcoin and crypto have bifurcated in an interesting way. Institutional investors and regulators view Bitcoin, it's a commodity. This is an asset class that is maturing. It's stable. It's fully decentralized. There isn't a central party. There isn't a central controlling actor who can do anything with it. And Bitcoin never issued Bitcoins, if you would, as a way to raise capital for itself. So it is, of all of the alternatives out there, it is the one that would definitely never be considered for the Howey test. That being said, regulators are very focused on the decentralized finance or DeFi businesses that trade these altcoins, the stable coins, especially coins where the issuer essentially issued a lot of coins, raised a lot of cash, and the coin doesn't serve any particular utility. It's just used as a stable coin, Doge coins, things like that. So I think you're going to continue to find regulatory focus on DeFi, especially trading and how do you control the on and off ramps, if you would, of the financial markets. It's something that ever since 9/11, the government has been very focused on. So KYC, AML, et cetera. But for Bitcoin mining, we are essentially data center operators. We're focused really more on energy policy and energy politics. The regulators have, again, deemed Bitcoin a commodity. It's regulated by the CFTC and is freely tradable. If you look at now Bitcoin ETFs, the spot ETFs, and what that could bring, we believe that spot ETFs will attract new capital to the market. It's an easier, frictionless way to access spot Bitcoin price. And it will bring in capital from 401ks, IRAs, RIAs, and families, and will be a very positive thing.
All right, Fred, we got